Good morning and welcome, Patriot Radio News Hour. Joe and Jason on a hump day Wednesday. And man, what a Wednesday it was. We had producer price index. We've got retail sales. The banking crisis, it took a pause yesterday, back with a vengeance today. We're going to try to update you on all of it. But as we speak right now, another heavy down day on Wall Street. Gold continuing to hit, higher levels almost every day. Yesterday it took a day off, and a few dollars. That's all over with today. We're starting to talk about, is there going to be no rate hike next week? Right now it's a coin toss. It's 50-50. I mean, we were all convinced. Think about this. 1 week ago. Hey, everything's okay. Nothing's great, but nothing's horrible. Fed's probably going to raise a quarter of a point, maybe the whole year. 3, 4, 5 more meetings of quarter of a point kind of stuff. How quickly things change. And of course, once again, where was the oversight? Where was the central bank? Where was the Federal Reserve Bank of San Francisco, as all of these banks had all of these risks? But the story of the day, Credit Suisse, big trouble here. Stock now below $2. The EU now is starting to call the other mega banks, inquiring about exactly what is their exposure to Credit Suisse. Credit Suisse default swaps. Man, it's going so quickly. Hit a record high. Okay, that's not good. So that just means, hey, their unrealized losses are massive. The fact of the matter is, other banks now seemingly, Jason, don't want to do business with Credit Suisse.
Yeah, if this keeps continuing, we're going to have it to where a lot of banks aren't going to be doing business with each other. This is what it is when credit freezes up. The financial system freezes up is because everybody becomes paranoid of doing business with everybody else. Banks that are short, that need help, can't get the money they need to solve their problems. Banks that are doing better don't want to do business with banks that might have problems because it might be contagion. So, Joe, I mean, you were mentioning things were better, a week ago, and I think economically things got bad in 2019 and really haven't turned around at all. And we're just seeing the after effects of just decade after decade after decade of bad policy. And the standard of living for Americans is just going to keep on getting lower. I mean, if you could have bought gold a month ago, maybe a little better than buying it today, but buying it today is going to be a lot better than waiting till next month to buy it, Joe. That's what it's starting to look like.
Yeah. Remember, we were talking to people. Hey, you can wait if you want to pay more, but this is now spreading here. Downgrades coming out all over the place. First Republic, we'll see. Listen, this may be another bank where over the weekend more banks get shut down here. We'll see S&P today downgraded First Republic into junk status. Moody's has First Republic on credit watch negative. We'll see if that changes. Yesterday, there was a little bit of a relief rally that kind of fizzled at the end of the day. But I'm going to give you a list, just some names that we're hearing now. This is coming out of Moody's. Banks that are now on credit watch negative: Zions Bank, Comerica Bank. I mean, these are some banks, Jason. People have heard of these banks. They're not huge, but they're significant. What I'll call, kind of regional type banks. And Jason, once again, the Fed was hoping, hey, we're going to take care of these two. We're going to take Silicon Valley Bank and Signature Bank. We're going to guarantee those deposits and hope that the problem went away. I think what happened with Credit Suisse today, Jason, not only did the problem not go away, now all of a sudden the problem looks like it's gotten worse.
Correct. And once again, like a broken record, all these financial institutions are linked together in many ways. And so this bank in America is unhealthy, and they've heavily invested in some bank in Europe. And this bank in Europe is invested with another company in some other country. It's so tied together. And when one domino falls, it can affect a whole lot of other dominoes. And yeah, what are we going to do, Joe? We're going to wait around and see how bad just a few of these banks are going to cause pain and suffering to all the others. It's starting to look like all the regional banks are going to really be taken on the chin right now, doesn't it, Joe?
Yeah, and these downgrades, here's what makes it so bad. It now makes it more expensive for these banks that were already having problems. When you all of a sudden fall into junk level status, all the money you need to borrow, it costs a lot more. So this again, it's just, you're piling on here at a time when they're already under extreme stress. But Moody's said similar downgrades, like the one they did on Signature Bank. Of course, we know what happened to Signature. Could be very similar coming for Republic Bank, First Republic Bank, Zions Bank, Western Alliance Bank, Comerica Bank, UMB Financial, and Intertrust Financial. So now they're starting to name names here, Jason. And guess what? Remember Janet Yellen? Oh, well, we're looking at a few banks. Must be like, what was it, Gremlins? Somebody added water to the banks, Jason, and these few banks, they've multiplied. Patriot Radio News Hour. We'll be back after the break. Eight 800-951-0592. Joe and Jason, Patriot Radio News Hour. Quick look here at the markets. The Dow's down 500 points. It's early. I don't think we're going to get a big rally here. This could be one of those days late in the day where things get worse. As again, this is all banking sector related. The S&P's down 50, the Nasdaq's down 100, gold's up 20 here, $1,930. Silver's just above unchanged. Silver's up 5 cents, right at $22. And just so you know, the bond market, another major sell-off. I was only 17 in 1987. This is even worse than the financial crisis. This is not a good sign. Bond yields just coming undone. The 10-year note right now, 3.43, but it was as low as 3.36 this morning. So again, this is a sign: more stress, more pressure, more deposits being turned into, we're going to hide into the treasury markets, which means more stress on these banks. This market recap brought to you by our friends at YRefi. Man, this is looking like a nice little alternative. If you don't want your money involved in these banks, check out our friends at YRefi. You can get up to 10.25% return, even if you wanted to put your money there for a year. Maybe you want to take a year time out. They'll still give you 6.25 for 1 year. If you do 5 years, 10.25%. You got to have at least 50,000. Everyone knows that, but check it out. Invest, YRefi.com. That's the word invest. The letter Y, REFY.com, or 888-YRefi24. And Moody's had more to say. And again, S&P today now. So it started with Moody's. Moody's has also, they sent their spokesman out on TV to tell the Fed that the Fed should not raise rates next week. But Moody's saying that unrealized losses on these banks' balance sheets and the fact that depositors, Jason, are leaving in droves, the market has not settled. That's the one thing I think we can agree on. We've got more of this to come. Right now, I think it's a coin toss. It's 50-50 whether there's a rate hike Wednesday. If they need to close more banks over the weekend, because that's what they like to do. right? They usually like to close them on the weekend. Silicon Valley Bank got so bad, they couldn't even make it to the end of the day on Friday, but they did all the dirty work. Signature Bank got closed over the weekend. If there's more bank closures, I wouldn't be shocked if there isn't a rate hike. They want to. I firmly believe the Fed wants to do a quarter of a point. If there is no rate hike, Jason, I think gold's going to be $2,000 or higher if there's not a rate hike.
Yeah, you brought it up yesterday, excuse me, and I was looking at it last night, the record amounts of money being deposited at the big banks. When we talked about Silicon Valley Bank, Joe, 85 to 90% of the money that it was not insured by the FDIC, at least by the rules they had a week ago, which was anything over $250,000, which means a lot of their deposits were above that threshold. That kind of money at these other banks, Joe, is moving towards the big banks. This indicates very, very much so that even if you had a bank that was doing okay when this was going on last week, if they're, just like you said yesterday, and we've talked about, they start moving, the big guys moving their money out of these regional banks and putting into the big banks because they feel safer there. This could go on and on and on. I thought it would take a little while to settle into the system, but now it's very possible this is just going to keep on going, Joe. And those bigger depositors, they make the biggest waves when it comes to the banking crisis.
Yeah, and right now for these banks here at home, that the banks that are getting on, either getting, like, first of all, actually getting downgraded to junk, other ones being put on credit watch negative. Here's what you can assume very simply. They have a smaller group of large depositors. That puts those banks at risk that, hey, if they lose just a couple of those large depositors, they've got a problem. So when I'm seeing now, we're seeing these banks talking about, hey, we've gotten the mega banks 15, 20, $30 billion in deposits just in the last 24 to 48 hours. This just tells you massive amounts of money coming out. But now Credit Suisse changes everything, because that is, a quote unquote too big to fail bank. But the ECB this morning, officers from the European Central Bank contacting lenders that it supervises. So my guess is our central bank's doing the same thing. I haven't seen the headline yet, but I would be shocked if our central bank wasn't calling up B of A, wasn't calling up JP Morgan, wasn't calling up Citigroup, maybe wasn't calling up some of these larger regional banks and saying, hey, what's your exposure to Credit Suisse? What's your exposure? What kind of losses are you going to take? They said if the ECB does not handle Credit Suisse well, this will send shockwaves through the whole sector. And here's the problem. There's no good way to handle it, Jason. If they don't handle it well, there's no good way to handle it. They're practically insolvent.
Well, and the way that they're trying to hide the fact that it's not it's not going to be a bailout by the people is, the Fed's going to offer. We talked about this before the show. The Fed will offer a 1-year loan. And they give you full value because the assets are lagging. They're not worth as much as when they bought them because the interest rates are going up. It sure has the feel that the Fed is getting ready to just swat some small guys down to the ground, knock them out, Joe, because you give them this 1-year loan at full value. And Joe's telling me, well, how are they going to be able to pay it back? They're probably not going to. But it buys these banks that, if they can quell this whole thing, Joe, these banks will be taking this Fed loan. And then in a year from now, just imagine if I'm right, they keep raising rates a quarter point every 6 weeks let's just say almost for the rest of the year. Those banks aren't going to be able to pay those loans back. They're just going to go under. Then guess who gets all the assets, Joe? Sure feels like a takeover is happening right now. That's what it feels like.
Yeah, it's going to be really, really interesting. It's complicated, but really not that complicated. Like I said, it's now a 50-50 shot that we even get a quarter of a point. I was watching the Idiot Box this morning. It was early, 4:30 this morning, and guest after guest after guest. The Fed shouldn't hike. The Fed shouldn't hike. Heck, you had guests out there. The Fed needs to cut, right? The Fed needs to stop quantitative tightening and all this other things. I think we're much closer to that than we were a week ago. Much closer. If we do hike, my guess is this is probably the last hike, but even so, we're much closer to the end here. I think quantitative tightening would be, I think that would be next, right? We'd stop raising rates. Then the next act would be we're going to stop quantitative tightening, because it really wouldn't make sense. If all of a sudden all these banks got to start borrowing money from the Fed, them doing quantitative tightening makes no sense.
I know, Joe, that, but I keep mentioning, are we going to see a situation where the money is printed and given out, which that's what a Fed loan would be, printing money and giving it out, and interest rates and continuing to go up? I wonder if this is where we're headed. It sure looks like we're going to have the Fed giving money out to qualm some problems and then continue to raise the rates. I know Wall Street wants them. It comes down to a question: if the Fed really wants to control inflation, if they really don't want that to get out of control, it becomes who's more powerful, the Fed or Wall Street. And we know it's the Fed. The Fed has all the cards, Joe. They have the power. They can do whatever they want.
Yeah. And the biggest backer for the for Credit Suisse is the Saudi Sovereign Wealth Fund, which the kingdom is the majority owner of that fund. You can buy up to just under 10%. That's kind of like the rule. Anything over 10% ownership requires a whole lot more financial bumbo jumbo. And obviously the ECB does not want Saudi Arabia owning Credit Suisse. And they already have a 9.9% stake. And the Saudis today said, hey, we're not doing it. Don't worry. We're not going to ask. We're not giving any more money. They've already lost a third of their investment. And Jason, looks like they're probably going to lose all of it.
Yeah, that's pretty
the
big.
Saudis are kind of like the lender of last resort, right? When you're real desperate, you go to the Saudis.
Well, they own 9.9%, but my guess is if they're unhappy, who are the other big owners that are going to, well, if the Saudi Arabia's not going to be taken care of, they're not going to take care of me either, right? There's probably some this could quite possibly be the biggest problem, Joe. You were talking about it before the show today, but you've been watching Credit Suisse this whole time. This could be a big tipping point for sure. And yes, they would stop raising rates if Credit Suisse falls over and it starts going all, contagion all over the place. Then they need to have to stop raising rates, because they have a whole another nightmare getting ready to happen.
Yeah. And again, we did get some data out. So yesterday's CPI data wasn't great, right? Wasn't great. It was lower, right? Got down to 6. That was the headline number, 6% year over year. The core was a little hotter than they wanted, but today we got producer prices. Jason, it was ice cold, down to 4.6. So if you're in the no rate hike camp, that was a good number. The core number was actually negative 0.1%. Again, something that the Federal Reserve probably loved to see. Then the New York Fed Manufacturing Index, just horrible. Negative 24 plus, 3 times worse than expected. So another reason that maybe they could hold off. And then retail sales also down 0.4%. Core or strip out autos. Retail sales were down 0.1%. So the Fed does have at least a few numbers that would say, hey, maybe all of a sudden their disinflation talk could reappear.
Yeah, very, very possibly, Joe. Yeah, it's a weird word that they can define any way they want, anyways, I guess. So yeah, I thought disinflation. I think that word will pop back out here in the future. And I guess when it comes down to this weekend, Joe, I guess halting rate hikes, I guess it's possible, but I just feel like the Fed's going to do it, but who knows? I mean, last weekend was crazy. If it gets a little crazy by the end, this is only Wednesday. If it feels like these guys you can almost feel the angst for these guys to try to get to the weekend, right? You can almost sense it in the air, right?
What, here's what's clear to me. I now understand why they went 50 basis points in December and 25 basis points in February, because I think they saw the stress in these banks. And I think that they needed to find a way to say, hey, we've got to stop sooner or later, because I think they knew this problem may come. I think they were hoping that the weak talk would be enough to save it. And then when all of a sudden, when the numbers came back in and they weren't weak, jobs were still really, really strong. They had to adjust all those inflation numbers. Jason, it kind of blew up in their face. But now it makes sense to me, right? They know the banks can't take much more of this because they're exposed here. And it's not all the banks. It's kind of weird that the safe haven play's been go to the mega banks, but now Credit Suisse's problem says, right, maybe this thing is just everywhere.
Right. And stopping the rate hikes and quantitative easing is the play for the big players, for the big banks, for the big companies. Really, if Jerome Powell was actually trying to help the citizens, he would keep raising rates, Joe, and let these things fail,
absolutely.
Right?
Well, if he was trying to help the citizens, we would have had 5% rates last year, right? They didn't have.
Right.
They could have been raising a whole point every meeting. Heck, they could have raised 2 points. That was never the objective. The objective was, how high can we go until we break something? Apparently, we found out, and it really wasn't as high as people thought. Patriot Radio News Hour. We'll be back.